Hi, Brian.
Hey Beth.
Is Steve coming on pretty?
Yeah, he'll be on in a few moments. Can you hear me all right?
Yeah, sounds good. At least we see each other this time.
Yes. I know.
Do you have a lot of people come to your booth?
Yeah, a lot of people have come by. It's been great.
Hi,
Hey Dave.
Steve.
Hello, everyone. Beth, how are you?
Good. How are you?
Doing great. Brian, you look like you clean up well down there.
So we have let's see how many participants. We're going to have about 130 or so participants. We're right at 25 now, so we'll
Terrific.
keep it going.
Nice.
And
It
then
was funny. Our first,
I have screen share. Yep, I'm good on screen share.
and we're recorded. Let me just.
Yeah, we're recorded right now, right?
Yeah.
Mm-hmm.
Yeah.
Beth,
So
is
best
that an
behavior,
office?
Steve.
Yeah.
Well, no promises on behavior. I went back to my office for the first time since last March yesterday.
Wow.
It felt pretty good, actually. It felt really good. I do have to ask for grace in advance, though, because my children are on summer vacation. So I've asked them not to run behind me, but I can give you no promises.
Did I just lose Brian?
I'm not sure if he muted or if he left us. Looks like he fell off. No, it looks like he's now in the attendees rather than the panelists.
Oh, okay. So how do you want, if we get questions, do you want me to just ask them to you, or is he going to send it to you in the chat?
I have no problem with you asking as they come in. They'll come in through chat, correct?
Yep.
So I'll leave my chat open, and then if I see them, I'll try to address them. And we just so I remember, when do we need to be wrapped up by today?
You have an hour.
Okay, so I'll try to wrap up my comments, somewhere around kind of 45 minutes or so, and then I can take 15 minutes of questions or so. Might even be a little bit earlier. Or actually, can I see those? If I have the chat window open, will I see questions that come in, or will those only go to you, Beth?
Well, I have two things open. I have the chat in Whova, and I see it on Zoom. So if you want to ask people to put it in Zoom, you can see it there too.
Yeah. So actually, why don't we do this? I'll focus on the presentation to start, and then if you could track questions and then ask them at the end, that probably works best.
Okay, good. And everyone heard that, so they'll know.
Even better.
Oh, yeah. He got booted out and can't get back in.
Oh, is that what's going on?
That's weird. Oh, I think I know. We had him with two different emails, and I deleted one of them. And so that was probably why I didn't see it. I don't know. But I just sent it to him again, so hopefully.
That's a good sign, I think.
Oh, good. I just sent it. Yeah.
There he
Hi,
is.
Brian.
I'm back.
Well,
How did it get rid of you so fast?
I don't know. I could see and hear both of you, but for whatever reason, it wasn't allowing me to be in presenter mode. But here I am.
Okay, so do you want to introduce Steve?
Yes.
Okay, good. Because I don't know enough about him to do that. So we have like 2 more minutes, and then you can do that.
Okay.
Just so that everyone is aware, I mean, I am capable of introducing myself in a pinch, so we'd be okay. I like to joke around that whenever my wife asks me to go to dinner with a new couple or something, I just kind of sit there for the first 10 minutes or so quiet, as I'm waiting for her to introduce me like you guys always do. But, she never does. She just kicks me under the table.
So our first speaker this morning, he didn't show up till 10:02, so I had no idea if he's going to come or not. So it was pretty scary.
Hey Beth, I keep getting booted out and then brought back in. So if I disappear, that's what's happening.
Okay.
Beth, that's why you want to know how to dance. That way, if the speaker doesn't show up, you can just start tapping.
Oh, okay. All right. That's good. We could wait a couple more minutes and then we can start. After your first session you did in November, that's why I decided to do this as a webinar versus the regular Zoom meeting, because everyone kept on talking to each other and had all their things on, like their screens on. It's like, we're doing it as a webinar. They're only going to see the panel.
Well, that's fine.
Sorry,
and I do see now, I've got the chat up. I see a number of people have said hello. So I will be able to kind of at least keep an eye on that chat as well within Zoom.
Oh, great.
I'll monitor it as well, Steve.
Great. Oh, goodness. Yeah, you weren't lying about having quite a few folks calling in. That's great. Hopefully, I won't disappoint a larger group of people.
I'm just excited that people are getting on, because this morning we were getting all these like, I can't get on, I can't get on. So
I actually, I'm doing media tomorrow. So for folks with insomnia, I'll be doing the 5 a.m. hit on Worldwide Exchange on CNBC, and then I'm going to be on Bloomberg at 7. But I just got word that Bloomberg is starting to allow one guest in person per show. Apparently, you need to submit to rapid testing when you get to the studio and things of that nature. But I'm hopeful that at some point when we have a meeting, it'll actually be a meeting with groups of folks in a central location. So here's hoping. And then no one will get booted out of a Zoom call at that point.
I'll have no excuse, Chevy.
Yeah, you'll just have to be there, I guess.
I think you could start if you want, Brian.
Sure. All right. Well, good afternoon, everybody. Welcome to the economic update. My name is Brian Willer, as many of you know. I represent Federated Hermes and the MMDT relationship. So we're excited to be here again today. Thinking back, this is much different, right, than our typical Cape conference. So it's fortunately, it seems as though we're getting back to having live and in-person meetings and conferences. So hopefully we'll be seeing all of you soon, especially when it's such nice weather out, and this is usually held on Cape Cod. So next year, fingers crossed, everything will go as planned. But like I said, we're excited to be here today. Joining me is Steve Cheverone. He is a really great partner to us folks out in the field who are meeting with our clients, and he's a portfolio manager on our global allocation fund, and he's a equity strategist. And you can see him, and he was mentioning in this when many of you were joining the call, but he frequents Bloomberg, CNBC, Fox Business, many other media outlets. So if you turn on the news early in the morning, you can quite often see Steve giving his and our firm's opinion over the markets or certain sectors of the markets. And what I like most about Steve is that he's not afraid to give his opinion. His opinion is often supported by data and facts. And he's not shy with answering your question fully. And so we strongly ask you all to bring up the chat, ask questions about things that you're seeing out there, questions that you may have on the economy. We gave this a similar presentation last year, November 5th. So as you recall, that was 2 days after the presidential election. There was a ton of unknowns out there, right? We didn't know who the president was, although it was 2 days removed from election night. COVID cases were still pretty high. The variant was picking up speed. Phase 4 of the stimulus plan was still unknown at the time. The federal deficit was growing. But Steve showed up and walked us all off the ledge and said, everything is going to be okay. I feel as though the economy's it's in a tough spot, but I'm fairly bullish. And in fact, Steve, I pulled data on November 5th. The S&P 500 was at 3,510. As of last night, the S&P 500 was at 4,255. So the S&P 500 grew 21% since your comments on November 5th. And so you were right. Things were going okay. The economy grew, continues to grow, and the stock market has certainly put up some nice returns since then. However, there's still a lot of unknowns right now, right? We can't turn on the news without hearing the word inflation, labor shortage. The federal deficit is still growing. Is that a concern? There's still the looming infrastructure deal so there's a lot of still unknowns about what's going on with the economy. So that's why I think it's a great opportunity for Steve to walk us off the ledge if these concerns shouldn't be concerns, or maybe they are legitimate concerns and we should be a bit cautious now. And so that's why I'm excited to hear what you have to say. There's a lot going on with the economy reopening. There's a lot of good things that you're hearing in the news, but there's also a lot of bad things as well. Unemployment's still high. So love to hear your opinion, Steve. I'll turn it over to you for some more formal remarks on, I suppose, as to where we're at right now, what you're thinking, and what's your opinion on the economy going forward.
Great. Thank you for the intro. As happy as I am that we've been more right than wrong since November, I think I want to be even more right now, so that when you all reconvene in the Cape, you invite me, because that sounds like a much more enticing destination than my living room. Although I have enjoyed my office, I guess I have enjoyed it here. So yeah, we're going to go through all that. I'd say, I like to start kind of with the bottom line. I think there are a lot of things to be concerned about. I think some of those concerns do rise to the level of things that you want to monitor closely, and they do represent risk. Although by and large, I think you're going to find that much like last November, our view is going to be things are going to be okay. And we think that that's the most likely path forward. So what I'm going to do is I'm going to show some slides. I'm going to try to go about 30, 35 minutes. We're going to do this in plain English, talking about things that hopefully folks on the phone care about. I'm gratified that so many people tuned in, and I'm really grateful that you invited me back after November. And then we'll open it up for as many questions as you all can muster up. So with that, and to make sure we have time for that, I'm going to jump in and away we go. The economic recovery remains strong. I think we're going to find out in July that we've finished the recovery, that GDP is back to peak levels, that which was lost has been found, and we are now growing the economy to new heights. That's remarkable. That's in a third or a quarter of the time that it took us after the great financial crisis. As a check-in, and for those that tuned in November, these are kind of familiar charts, but we continue to monitor them. Unemployment claims, so the number of unemployed people has fallen greater than 80% over the last year. That is still the fastest 12-month improvement in the job market in the history of the United States times 2. So when we're talking about pulling, people off of the sidelines, that's true. We are still having some trouble getting this last group of people back to work, but my goodness, you've got a lot of people back to work very, very quickly. Housing market remains incredibly strong. You see a little bit of a blip in activity because we've had some supply shortages in terms of lumber. And so we'll talk about that and what that means for inflation, but generally housing remains incredibly strong, incredibly robust. In fact, as a teaser, I believe that we have 16 million too few homes in the United States, and we'll talk about why in a little bit. Manufacturing activity is at the highest level since I was born, which is, that used to be a shorter period of time than it is now, so that's actually a significant period of time. And retail sales are just absolutely remarkable. We're growing. It's almost as though the pandemic didn't happen. In terms of how we recovered with regards to retail sales. So everything kind of on pace there. Consumers' income remains significantly elevated since before the pandemic. Savings rates are very, very elevated. We've generally run for the last 20 years at a savings rate, at or below 5%-ish, maybe as high as 6 or 7. We're still running in the 15+% savings rate. Consumers, as of the current check, have roughly $3 trillion more in savings account balances now than they did before the pandemic. Recession, and we've all gotten $3 trillion richer. I'm going to pause real quick. Brian, if you can, could you unmute and just let me know that you're able to hear me, because your video has frozen. Yep. I just want to make sure I'm coming across. Okay.
Loud and clear. Yep.
All right, great. Thanks. In addition, when you look at unemployment, and I'm going to share some thoughts here as well, there's been some really remarkable things that have happened. So the very highest end industries, those industries that generally tend to have the highest incomes, tend to be most professional: management, real estate, mining, finance, and insurance. Job losses have been minimal, and in some cases, you've actually created jobs. Where you see still a ways to go is in jobs that generally represent lower income jobs: wholesale trade, hotel workers, restaurants and bars, administrative support, things of that nature. But you've healed quite a bit. Why do I bring this up? Because these jobs are easier to create. It's more about reopening the hotel. It's more about reopening the restaurant. It's a little bit more difficult to get these people off the sidelines, because in many cases, they may be making more money on unemployment than they would be if they go back to those jobs. So that's something that we're working through. But in general, you're much less likely to have the skills mismatches in these sectors of the economy that would make it harder to get these folks back. So there's a perception that jobs numbers have been weaker than expected over the last 4 months. That's actually nonsense. We've added 1.1 million jobs a month for 4 months. There's some quirks with the seasonal adjustments, which normally are designed to smooth the data to give you a clearer picture of the economy. But there's nothing that's seasonal about, a once-in-a-lifetime pandemic or a once-in-a-lifetime set of vaccines. And so we think that they're actually distorting the underlying trends. We think the real story is that unemployment and labor markets continue to heal. We think they're going to accelerate. You've got enhanced unemployment benefits in 25 states ending over the course of June and July. That should force some group of folks back. We expect to see positive seasonal adjustments in July. And something that's also very, very interesting that's occurred is this pandemic, from a labor market perspective, was particularly severe on women. You saw much larger declines or increases in female unemployment and females leaving the workforce than you did with men. That has completely reversed itself. It's completely reversed itself. Whereas as of today, the unemployment rate for women is lower than it is for men, is closer to where it was pre-pandemic, and so is the labor force participation rate. So I don't know if we predicted this in November. I know it's something that I've said quite often. Understanding women took it on the chin primarily because they were bearing a lot of the educational brunt. I expected that if anything, millennial age women would be exceptionally good at reentering the workforce, and they've done it at a rate that even I didn't expect. So Labor market, I think, remains strong. Corporate bankruptcies are back down below the levels that we were seeing pre-pandemic at this point. So we've saved an awful lot of companies. Corporate cash balances are double long-term averages. I mean, just companies are awash with cash, which means that credit is likely to stay quite good throughout the economy. And as we move forward, we think we're in a bit of a period of transition, that we are ending the recovery, right? We're getting GDP back. We're entering expansion. And the question is at what rate? Now, our base case view is that GDP growth of around 6.8%, 6.5 to 6.8% this year will decelerate gradually to around a 4.25, 4.5% GDP growth rate next year. That is slower growth, but it's still a very strong level of growth. Pre-pandemic, we were averaging between 1 to 2% growth. So slowing to a still very robust level of growth. We think that means inflation is higher and lasts longer, and we'll go much more in depth on inflation in a second, but higher and more durable than the Fed anticipates, but not the kind of runaway inflation that you've seen in the 1970s or 80s. That puts the Fed more or less on their pre-communicated path, probably accelerates it some, and it implies a pretty benign policy outlook. That's our base case scenario. On both sides of that, there's the risk that inflation actually does continue to run not just above pre-pandemic levels, but at 70s, 80s style levels. And that causes a series of issues in terms of much higher yields, more inflationary pressures, and ultimately a shorter economic cycle. It means recession sooner than you would expect otherwise. And then there's a downside case that you decelerate as we expect, but you go down faster. That some new variant like the Delta variant has a bigger impact. And we don't think that's the case, but if something like that were to happen, or that you pass infrastructure spending and you actually have a hard time engaging in the infrastructure projects, but some of the pay-fors that might include tax hikes or tapering or fiscal cliff, drag you down a little bit faster than expected. That's our lowest probability outcome. But this is how we're thinking about expectations going forward, and I'll go more in depth. One of the things we do at Federated Hermes, and I kind of oversee this, is we like to have systematic frameworks for making major calls. So this is our recession dashboard. I won't take you through all the details, although I'd be happy to in Q&A. But we believe that the best predictors of inflation are unemployment claims, increases in core PCE as an inflation metric, housing activity, because we still have a significant portion of the population's wealth in housing, and what's going on with housing starts, the yield curve as a predictor of recession, high yield spreads as a predictor of credit quality, and ISM manufacturing as a predictor of what's going on in the manufacturing economy. To make a long story short, based on the way that these indicators have traditionally responded or acted, 5 out of the 6 indicators show very, very low risk of recession, although inflation is starting to flash a little red. So we've got to watch that. And by and large, based on the way these indicators have normally acted, you should expect no recession before late 23. And that makes sense because that coincides with where the Fed has told us that they would start to raise rates. Moving forward, I'm going to say something a little bit controversial. I think we're at herd immunity in the United States. And I think we've done basically all that we need to do in terms of vaccination. I think we can go further and really try to eradicate the virus. But let me kind of walk you through that, because I know that those are two fairly controversial statements. The first thing is the Cleveland Clinic came out a couple of weeks ago with a study that suggested strongly that the immunity that you acquire from a past COVID infection is essentially on par with the immunity that you acquire from a vaccine. That's different than what the thinking had been. Well, what you see here on this chart is past infections plus folks who are vaccinated, and vaccinations only. You'll also notice we're there, folks. We're in June, and when you add up all 3 of those groups, past infections, vaccinated individuals, folks with a combination of both, we're at the 70% threshold. In fact, New York City today, or New York just announced that because their state had crossed this 70% threshold, that they were removing a lot of restrictions. And you can see that the US, the UK, and Chile, I don't know why Chile has been so good here, but have really led the world. Importantly, though, Europe, which had been lagging significantly in terms of their vaccination rates, have really started to move up and give us a lot more confidence in the picture in Europe as well. In addition, 80% of the deaths, 82% of the deaths from COVID were in a population of folks that were 65 years and older. Really, you're in the 96, 97% when you look at folks 50 years or older. We have, and this data is a month old, or almost 2 months old, we had already, as of 2 months ago, vaccinated 3/4 of that population, 65 folks 65 or older. So I think the story is that COVID can still be disruptive, COVID can still make people sick, but we've probably done what we need to do to avoid the most dire health outcomes, meaning deaths, and at a large scale, anything that would kind of overwhelm hospital systems. And obviously, we've seen hospitalizations really kind of collapse in the US. So we feel pretty good about the trajectory of the virus. We are watching the Delta variant in the UK. You have seen a pickup in cases there. Although I think it's important to remember that the UK has a much larger percentage of their population with the Astra vaccine than you have in the United States. And studies suggest that the mRNA vaccines, Moderna and Pfizer, are at least 80 to 85% effective against the Delta variant. So again, I think the days of COVID having major economic impacts are probably behind us. There's still a lot of reopening to do. You know, big states like New York and California are still only in that 40, 50% reopening phase. That's going to really explode in the next month or so with some of the announced reopenings there. So we expect to see more activity unleashed. We think that this quarter, the second and third quarters of this year are going to be the peak of economic activity in the V-shaped recovery. In addition, massive fiscal stimulus. So in the United States, fiscal stimulus thus far has represented almost 30% of GDP. And that does not count the roughly $4 trillion of spending that has been proposed. So, you know, we're starting to push World War II levels of fiscal spending in support of this economic recovery. A lot of that in the last bill, that $1.9 trillion bill, is front loaded. It hits in 2021, and it is aimed at the consumer. So we expect consumers to be quite strong in the back of the year. Remember as well that what we have not seen hit yet, which will start in July, is the enhanced child tax credit, where half of your child tax credit, which is going from $2,000 per child to $3,000 for children over the age of 6, $3,600 for children under the age of 6. That amount is going to be split in half and paid in monthly installments starting in July. So for each child, families should expect roughly $200, $250 per month per child. For a family of 3 children, that's $750 a month in direct payments from the government. Now, again, that's a borrow forward from the tax credit to come in the new year. But for most folks going from a $2,000 to a $3,600 credit, they're going to make out better in both cases. Taxes do present a higher risk, right? So when you think about the agenda that's been laid out by the White House, it's 2 major spending initiatives that they've expressed interest in. Originally, a roughly $2 trillion infrastructure spending plan, more kind of traditional infrastructure with a lot of green investments as well, backed by higher corporate tax rates. So taking the corporate tax rate from 21 to 28%, creating a 15% minimum tax rate, doubling the global minimum tax from 10.5% to 21%, things of that nature. And then a second program of spending, which I would call more social spending programs. These are things like universal daycare, universal pre-K, free tuition for historically Black colleges and universities, things of that nature. And that would be backed by higher taxes on individuals. So raising the top marginal rate, taxing capital gains and dividends at a 40% rate for those making over $1 million, capping some deductions, maybe eliminating the gap on or the cap on Social Security or bringing it back after a gap rate. Obviously, estate taxes would be part of that. I think that the outlook for higher taxes has changed meaningfully, as has the outlook for spending over the last week. And so what I'm about to say is not a statement of something that I think is good or bad. You have to buy me a bourbon to truly know. But I think if you were happy about the prospect of additional government spending backed by higher tax rates, what I'm about to say is disappointing. If you were unhappy about that prospect, what I'm saying may be encouraging. And I think it really centers around the G7 agreement on the corporate minimum tax. So as you know, President Biden and Secretary Yellen have kind of twisted arms at the G7 in order to secure a commitment at the ministerial level to push towards a 15% global minimum tax rate. Now, that agreement carries no rule of law whatsoever. The ministers have no power to enforce that. Each of those countries needs to go back to their legislative bodies and get it passed through there. The problem for the Biden administration is because they've led this charge, it would be exceptionally embarrassing to lead the charge and not be able to deliver such a provision through their own legislature. For fans of history, it would be akin to Woodrow Wilson founding and starting the League of Nations, and then the United States being the only nation that doesn't join. Well, that means he showed his hand in negotiation. The Republican senators with whom he's negotiating now know that he needs to have that corporate 15% minimum tax rate. And so I think that's all he gets, in other words, right? You want the corporate minimum tax rate, you need the corporate minimum tax rate, fine, but we're not going to raise corporate taxes from 21 to 28% or even 25. We're certainly not going to double the tax on capital gains, and your $4 trillion in additional spending is going to be something more like 1.5. The only way around that is if the president and the Democratic Party go the reconciliation route in order to try to pass their agenda without Republican support. But I would say that the op-ed that Joe Manchin wrote in the Charleston Gazette last Sunday, if you haven't read it, is essentially a declaration of war against that path, where he said that he would not agree to support the voting rights bill that he co-sponsored 2 years ago because it didn't have bipartisan support at any level, and that he would not support getting rid of the filibuster, and he's not in favor of doing infrastructure spending through reconciliation. So unless the party can convince Sinema and Manchin to go that route, they're going to have to negotiate with the Republicans. And from this list, I think you're probably looking at $1 to $1.5 trillion in spending in total. I think you probably could get the top marginal rate back up. I think you might be able to see something done on SALT. I think maybe you could do something on estate taxes, maybe. And I think you can get a corporate minimum tax to 15% and maybe a global minimum tax increase on offshore profits. I think the rest of this is going to be very, very difficult to get past. Just playing it out for those that are interested, we think on average, tax increases would hit corporate earnings, but we think it's relatively modest. You're still going to be looking at an 8 to 10% growth rate next year versus a 15% earnings growth rate. So we think corporate profits are going to rise either way at a pretty strong rate, even if we do get some of the more draconian tax increases. I'll skip this slide. I would say, just something to keep in mind historically, what you see here is the top marginal tax rate every year since 1940 in the United States, ranging from 80% at the low to sub 30, 80% at the high in the 1940s to sub 30% in the 1980s under Ronald Reagan. You will observe, however, that regardless of where this top marginal rate is, government revenues have been stuck between 15 and 20%. And it's unclear that really any tax regime is going to give you, allow the government to raise tax revenues really above that 20% rate. We've never successfully done it in the last century. I'll skip here. Again, the linchpin politically, obviously, Manchin gets a lot of the attention. Do not sleep on Kyrsten Sinema and John Tester, particularly on tax policy. The Fed and inflation. So the Fed has been obviously quite dovish. Central bank balance sheets have exploded to the upside. Prior to the great financial crisis, the Fed had a balance sheet of roughly $1 trillion. That was somewhere in the $4 trillion range, leading into and subsequent to the great financial crisis. We're now at 8 trillion and still climbing. So we've doubled even off of the levels that we saw post-great financial crisis. And frankly, that's not out of lockstep with any central bank of size around the world. We've seen 10-year yields rise sharply off of their bottoms from last year. They've stalled in this 1.5 to 175 range. There's a question as to which direction they're going to go. We believe that direction is higher towards 2%. And it's really a question of inflation. So we've seen commodities prices, surge, corn up 79%, lumber up almost 600%. And I won't go through all of these, but you can see the numbers and the incredible move higher that we've seen across a range of commodities as inflation pressures have built. What I want to show you here is our new inflation dashboard. This is something we're going to be putting out on the web and posting every month.
Hey, Steve.
Yeah.
I just had a question on the previous slide, not to interrupt you, but
yeah.
You could go back. What's driving this? Is it because the supply chain is messed up because of COVID, or is it because of people have a lot more money because they haven't spent money in the last 15 months and they're going out spending it, and the supply chain is just not ready for that?
Both.
Or is it different for every commodity?
No, it's both. Like I like to tell the story on oil, right? I didn't do any oily things last year. I didn't fly. I didn't drive anywhere. I didn't go on vacation, right? I stayed at home. It was so bad that I even watched half of an episode of Bridgerton, which is the worst thing I've ever had to suffer through in my life. Right, but I was locked at home, right? I wasn't allowed to leave, and I had watched everything else there was to watch, and my wife said that I had to watch it, so I listened. But 2 weeks after my second vaccination shot, I want to do all the oily things. I want to fly, I want to travel, I want to go out to dinner, I want to see family I don't even like twice because I haven't seen them. I'll be flying across country on Tuesday, as an example, for to see some clients and to see some family. And so, right, my oil demand picks up immediately, but that doesn't mean that the oil company just starts, pumping more oil out of the well. They've got to re-permit the well. They've got to get the equipment in place. They've got to drill it. They've got to get the distribution contracts in place. There's a mismatch. People were willing to go out and engage in buying on Memorial Day, but they don't want to go back to work until Labor Day. And that makes sense. I'm not saying there's anything wrong with that, but you have this mismatch. The problem is, though, there's also some other issues. For example, between 1980 and 2007, we built on average 1.6 million homes per year in the United States. We have built a little less than 1 million homes per year in the 15 years since. But that's wrong, because there's 92 million millennials replacing 77 million boomers. So they should require 7.5 million more homes. And we've underbuilt by 600,000 homes per year for 15 years. So you add that together, you get yourself a housing shortage of about 15 to 16 million homes. Think about a lumber company. They had to downsize their sawmill capacity from an economy that was building 1.6 million homes to an economy that was building 1 million homes. Now, yeah, you've seen prices move up, you've seen housing activity move up, but is it real? Is it transitory? Fed's telling me everything's transitory, right? So am I really going to build that next sawmill? And so we think that it is a mismatch of supply and demand. We think that it will hit equilibrium at some point and prices will moderate. We just think that these companies in the commodity space are going to be very reluctant to overbuild and overproduce. And so the supply response will be weaker and slower than it would be otherwise. And then also, you've got a lot of pent up demand with consumers sitting on more money than they've ever had. So it's all of that together. And let me kind of walk you through in the next slide how we think this plays out. So I'm not going to get real technical here. A number of inflation measures. The Fed likes to look at prices of what we buy, prices of what we sell, and then we like to break it down between services and goods, prices that tend to move a lot versus prices that tend to be more stable, what expectations are for inflation, and what labor costs. In the current set of data, here's the story that emerges. Prices are high. We're seeing inflation that's at least the highest in 20 years, in some cases even higher versus a longer term history. but that inflation so far has been in goods and not services, which makes sense because we've been locked in our homes. So service prices, which make up a bigger portion of the economy, are actually relatively well behaved, and that all of that inflation has really been in flexible price goods, things that tend to be volatile, so they can run up and they can run down just as quickly. But that inflation expectations are well centered around where they should be, but employment costs and wages are in a potential warning sign. That's where we are right now. That's why the Fed is patient in the face of higher inflation readings. However, and this is the critical point, if inflation doesn't start moderating meaningfully now, we're going to have an inflation problem by the end of the year. If we continue at the rate that we've been going for the last 3 months, these measures are going to get to levels that are going to be way too high for the Fed to be patient. And so the story is inflation's okay right now. It's ringing some warning bells. And you really need to watch the data over the next several months because it should slow. But if it doesn't, or if it doesn't slow fast enough, you're going to see a Fed that's going to altogether have to be a little bit more aggressive. So I don't have an answer on how it's going to play out. I can tell you of no examples of this kind of pickup inflation after a 40-year downward trend in inflation. And so our base case scenario, again, is inflation that is higher than it was before the pandemic for a couple of reasons. One, this pent-up demand, all the cash in the hands of consumers and corporations. A Fed that has gone from pushing against inflation and willing to accept excess unemployment in order to do that, to a Fed that is pushing towards full employment and is willing to accept higher inflation in that pursuit. So there's a regime shift at the Fed. Those are all of the upward pressures on inflation. The downward pressures on inflation are that demographically the world is aging, particularly outside the US. That's deflationary in general. We still have technology and its unrelenting assault on cost, the Amazon effect, the kiosk effect in the labor markets. And so how do we think about those two countervailing forces? We think it leads you to inflation that's higher than before, but not at the most worrisome 70s, 80s styles levels that we've frankly been living through the last several months. We have to see. We just have to see. And we're really not going to know until we get the next several months worth of data. So this is going to be what we look at to try to understand that. In an environment where inflation is higher, you really want to be invested in stocks. You want to be invested in value stocks, small company stocks, and international stocks and commodities. Within fixed income, you want to be in TIPS, EM bonds, and high yield bonds. You want to have less exposure to government bonds and mortgage-backed securities historically. And that's how we are positioned within our portfolios. Debt to GDP, yeah, it's high, it's rising. Interest expense is very well behaved. I'm going to go over this quickly. I suspect we may get a question on it, but for the sake of time, the story here is it is very unlikely in our mind that you're going to have a massive repricing higher of the interest expense. So debt will matter at some point, but not today, and tomorrow doesn't look very good either. PE multiples are elevated versus long-term averages, but they always are when inflation is in really the 0 to 4% range. They tend to move higher as interest rates start to inch higher off of very low levels. And relative to bond yields, the market's roughly 4 PE turns less expensive than you would expect it to be. So we're trading at a 21 PE. If you look at where bond yields are, you would expect to be trading closer to a 24 PE. We don't necessarily expect the market to get more expensive, but we also do not expect at all for it to get meaningfully cheaper. Against that backdrop, we think that we've been overweight small companies versus large, value over growth, dividend payers over the broad market, and international stocks over the US. All 4 of those have worked since we initiated that call in late August. International has worked the least well. It's outperformed by about 6%. The others have outperformed by somewhere between 20 and 30%. Why? The growth had a monster rally versus value in the 12 months leading up to last August, but you've seen earnings growth really shift to the cyclical sectors as part of the reopening trade. They're shorter duration assets. When you buy a growth company, you don't really get paid for owning that company until years later when they invent something new and have higher earnings and then eventually dividend payments. So it's a long duration asset, whereas value companies are a shorter duration asset. You get paid now. I get a dividend today or next quarter. And so when rates are rising, you want to own shorter duration assets because those higher rates don't erode the value of that asset. By industry group, when we look at sectors of the economy, what are those areas that tend to be best positioned for inflation and have been since Labor Day? Things that you would expect: financials, insurance, banks, energy companies, material companies, real estate does well. Some of the things that do worse or the worst are some of your tech companies. And again, that's historically been the case. That's the case today. It's one of the reasons why we're overweight value relative to growth. Just interesting for folks who are interested in this kind of thing. Autos had traditionally been a more value-oriented sector and did well in inflationary environments. Because of Tesla being as large as it is, autos now act like a tech sector. Why do we like small caps over large? Because they tend to do better in the first year following a recession, and they did very well this time around. We think that they should continue to do well as the economy strengthens. They will stop working, though, once rates start moving higher, because a lot of their debt is variable rate versus large companies where a lot of their debt is fixed rate. Dividend payers, we think, are the most attractive part of the market, full stop. The yield on dividend paying companies relative to treasuries, so a spread analysis suggests that dividend stocks are as cheap versus bonds as really they have been at any point, over the last 15 years or so. And relative to stocks, dividend stocks tend to trade right around the same PE multiple. You've seen discounts of as much as about 4% going back into 2002, or sorry, not 4%, 4 PE multiples. We're trading at somewhere around a 7 or 8 times multiple discount. So dividends are as cheap versus stocks as they have been historically. And I'll just skip back here really quickly. When you look at asset classes and how well they're positioned for a rise in inflation, dividend stocks tend to be about twice as good as even the best fixed income categories. So we think that there's a real theme here of using equity income to supplement fixed income. In addition, dividend cuts really stopped about a year ago, and you're running somewhere, 20 to 30 dividend hikes per cut at this point, which is a really good environment. Finally, internationally, international stocks have a very high beta to inflation, particularly when you're talking about Canadian and Australian stock markets. They also have more exposure to value sectors relative to tech. And so if you like value, you're positioning for higher rates and inflation, you probably want to be overweight international equity markets. That wasn't working in the first quarter because of the differential in vaccination rates. But as those have closed in Europe and other developed markets, we feel a lot better about those markets. I don't love emerging markets here, primarily because China has really transitioned from a value-based commodity economy to a tech economy. So it tends to trade more with tech. And their central bank is really fighting back against inflation and largesse in a way where our central bank is waving the green flag, or I guess it'd be the checkered flag. And so I don't really want to fight their central bank. Some of our forecasts, these need to move meaningfully higher on some of these. So we do have a 6.8% GDP forecast for this year, a 4.2% GDP forecast for next year. These inflation estimates of 3.1% on CPI and core PCE, these are wrong. These were our forecasts from about a month ago. With the most recent set of inflation readings, these are untenable. I would need inflation to fall 80% from the 3-year average rate and stay there for the rest of the year in order for us to end the year at a core CPI as low as 3.1%. So we are currently in the process of reevaluating those forecasts and voting them. I think the 10-year yield moves into the 2 to 2.25% range this year, maybe as high as 2.5% next year. We do expect that the Fed will not hike rates this year. It's potential that they could start hiking rates next year, but we still think early 23 is probably the best time frame. We think earnings growth will remain robust. We think the market ends up trading at essentially the same multiple, and we've got a 4,500 target in the S&P for this year and a 5,000 target for next year. I think I've talked about some of these, so I'm going to skip here. Just a piece of, I'll end here actually on a little bit of context and then open it for questions right at the 45-minute mark. It's a very simple study that I think just reminds us of how not to outsmart ourselves. So buy and hold. We made two assumptions. Investor one bought $100,000 of the S&P 500 on New Year's Eve, 1929. Another investor did the same, but then bought $1,000 a month every month from then until now, regardless of what was going on, right? So this period has depression in it. It has a world war. It has Woodstock. It has Vietnam. We've got hyperinflation. We've got oil embargoes, tech revolutions, great financial crisis. I mean, anything that you would really, pandemic, right? Well, it doesn't have pandemic in there yet. But in any event, and we ran that for 90 years. Here's the punchline. The person who was dumb and naive and just bought $1,000 a month outperformed the market in the 1930s, 40s, 50s, 60s, 70s, 80s, 90s, 2010s. Only in 2000 did they slightly underperform. And in doing that for 90 years, rather than earning 13,000% in the market, an average return of 5.55%, that dumb investor who simply just bought $1,000 a month, not worrying about any of the nonsense, earned a 92,000% return. They outperformed the market by about 2.25% per year for 90 years. So, you know, especially when you're thinking about long-term money, yes, it's important to talk about all the things that we've talked about. Timing matters, adjusting risk tolerances matter, but the most important thing is staying invested and not allowing those concerns that Brian started with to ever really talk you out of the market en masse. So with that, 45 minutes, I'm 46. I went 1 minute over from what I promised. I'm going to stop there, and I would love if there's a good set of questions to talk about.
Thanks, Chevy. A couple did come in. Both were related to inflation. So the first one was more about lumber prices. Your thoughts on when they will go down, if at all? I know you talked about it a little bit. Anything you could add there?
Yeah, well, I mean, they have started already. I mean, they're not quite as peakish as they were about a month ago. So, you know, they have come down some. What you saw kind of helping them to come down is the builders cried uncle, right? So when you think about it, if I'm a builder, in many cases, I contract today to build a house, you know, 6 months from now, and I usually lock in my cost estimate today. So what was happening with some of the builders and why you've seen housing starts fall a bit is they were saying, well, I don't want to engage or enter into a new contract to build today, something that I'm going to produce in 6 months with lumber prices surging, because I've got to eat that in terms of lower profit margins as the builder. So you've seen some of that activity slow a little bit, and that's taken a little bit of the edge off of lumber prices. I think lumber prices are likely to not fall back down to pre-pandemic levels very quickly. I think there's a couple of things that are going on here. One, we always thought 2020 was going to be an inflection year for housing, because the greatest predictor of whether or not someone's going to own a single family home is not age, it's not income, it's not down payment, it's not economic condition. It's the presence of a child. When you have a child, you tend to want to be in single family homes, particularly in suburbs. The schools tend to be better. You have yards for the kids to play with, and you don't have neighbors on all 6 sides of you, you know, banging on your wall anytime the child's loud, like you do in a multifamily apartment. And 92 million millennials, 60% of which were set to start hitting 30 in 2020 and do that over the next 10 years, between 2020 and 2030. So we thought that they would enter into the single family home market in a big way. That was obviously accelerated and exacerbated by the pandemic and the desire to get out of big cities. And I think the prevalence of flexible and hybrid working arrangements are going to further support more suburban living than what we had before. So with that scenario in place, we expect housing demand, particularly if we're right that we've underbuilt homes by roughly 15 million, is going to be robust for some time. We think those lumber companies are going to be slow. And then there's another element that's going on here, which is carbon offsets, right? So a lot of big companies want to be carbon neutral. Well, how do they do that? Well, they still produce all the same carbon that they used to, but they will buy a carbon offset. So in other words, I might buy a forest that exists and promise not to cut down a tree forever. And that's my carbon offset. Well, that means you got a lot of trees that can't be cut down. And if they can't be cut down, they can't be turned into timber. If they can't be turned into timber, they can't be turned into lumber. And so I think you've got that element at play as well. So, I think they were probably a little bit extreme in the short run and frothy. I'm not surprised to see that they've come down some. I don't expect that they're going to normalize, very, very quickly, unless you see the Fed have to go in about face and get very draconian on rates, such that you see interest rates rise sharply, and that hurts housing activity. But again, that's not what we expect to see.
Same topic, Chevy. Oil and gas inflationary pressures. Do you expect them to remain and climb, particularly due to the Biden administration's pipeline decision? Does that have much of an impact to what we're seeing?
Yeah, excuse me for breaking my arm, patting ourselves on the back here, but we had two really anti-consensus calls. I think I may have mentioned them in November prior to the election, that a Biden victory would be very good for financials and very good for energy stocks, which seemed completely counterintuitive. But our view was that if you had a pickup in demand in a post-COVID world with supply constraint, just because it takes time for people to come back, plus incremental regulatory policy that makes it harder to pump more oil, you're going to have a pickup in prices. And for energy companies that have a lot of oil on their balance sheets, they would benefit from that. And that has exactly played out. And I think it's likely to play out. I think the bigger story here is the pandemic and the pickup in demand and the supply cuts that had to occur last year because prices were lower. I think oil and gas prices would be elevated today, no matter who was president. I think incrementally, though, the Biden administration and its supply, its policies that are less supply friendly, make that a little bit worse. I also think, the oil markets had some bit of calm in them because you could rest assured if gas prices were sitting where they are right now, Trump would have done something, even if it didn't matter, at least from a perception perspective, in terms of releasing reserves from the strategic petroleum reserves or browbeating OPEC into increasing supply in order to get those prices down. And Biden's unlikely to do that because I think there's a part of the left that doesn't mind seeing higher oil prices if they think that hastens the move towards greener fuels and energy. So I think that there is a Biden premium that's being built into these prices that probably remains for a period of time. And so, I absolutely think that some of those decisions, I would say as an aside, though, regardless of the environmental impacts of pipelines, at least in my mind, the ransomware attack on the pipeline that happened recently, I was unaware that essentially a third of all petroleum products up the East Coast were on one pipeline, and something like 2/3 of the Southeast oil was on one pipeline, and some ungodly percentage of airline fuel was on one pipeline. And so I think from a national security perspective, we have to start thinking about, okay, yes, there's an environmental impact and it's a real one, but what's the national security impact to having so much of our natural resource on so few pipelines, which is something that, be interesting to see if Washington's thinking evolves because of that.
That's helpful. So you mentioned earlier, Federate's view, your view for short-term interest rates really aren't expected to go up until maybe next year. We're seeing more inflationary pressures, but more likely than not at this point, probably, or at the earliest 2023. We're seeing, a question came in about mortgage rates. They've been slowly rising. You mentioned the 10-year. Your forecast is, I think, 2.25 to 2.5. We're at 1.5 now. So if what your prediction is for the 10-year, one would assume mortgage rates will follow, right? And so does that have an impact on the housing market? And do you think mortgage rates will get to where they were pre-pandemic? It's kind of a loaded question, but just
I think they do. I mean, I think it depends on when pre-pandemic, because if you remember, we had gotten to a 10-year yield, up to 3%. in the late, I want to say, or early part of 2019. So I don't think we're headed there anytime soon. You know, the economy should not require 2 3/4% mortgage rates, right? I mean, we should be able to handle a 3 1/4 or 3.5% mortgage rate. I think, right, when you gotta separate direction and degree. Yes, all things being equal, a higher mortgage rate is not as good for housing activity as a lower mortgage rate. But when you're going from 2.75 to 3 1/4 or 3.5, these are still very benign inflation rates against, let's not forget, consumers who have $3 trillion in excess savings. Incomes that are rising at the fastest rate in 20 years, you know, and plenty of liquidity. So I really don't think that you're anywhere near that threshold where you're likely to impair housing activity. I think you'd really have to push those rates, you know, significantly higher. And even during the 18-19 period where you had mortgage rates, you know, in the 4s and even touching 5%, you didn't see a collapse in housing activity. It was still relatively robust. So I'm not really worried about those kind of interest rates because, again, I don't envision, although there's some risk to, inflation that's so high that, you know, we've got the Fed really hiking and you're in a scenario where, you know, you've got mortgage rates soaring. You know, our base case scenario is that if inflation does start to settle down, the Fed's plan of action is going to be to maybe hint that they're thinking about tapering tomorrow. We think that they'll probably announce their plans on how they will taper at the August Jackson Hole meeting. They might start that taper in the beginning of next year or the end of this year. They'll try to run through about 12 months of that, take them to the end of 22, take several months off, and then maybe start initiating hikes, let's call it in the, you know, middle to second half of 2023. If inflation continues to run hotter, you know, towards the level that we expect, so higher than pre-pandemic, but not maintaining 70s or 80s levels, we think that all gets accelerated by about 6 months. So they start, you know, maybe they announce how they're going to taper in August and start immediately or start within the next meeting or two. They only run around 6 or 9 months. They start hikes late 22, early 23. And so in either of those cases, I still think you've got rates that are, you know, slowly grinding higher, not shooting. With that said, though, Brian, as much as I'd like to continue to answer questions, I think we're about at the end of the hour. So for folks that didn't get a chance to ask a question, you know, if you want to reach out either through Beth or through Brian, I'm happy to answer that offline. In the meantime, I hope that this was a worthwhile session for everyone. I hope you got something out of it. I very much appreciate the opportunity to speak to you again. I hope you all are safe, and hopefully, you know, we get to do this wearing Nantucket red shorts in the Cape at some point next year.
Thank you so much. Really appreciate it. Just want to do a little announcement. We are doing our speed networking at 2. So you just join right in on the Hoover app, and then you will be placed into a group of 4. And every 5 minutes, you're going to be going to a new group, and it does it automatically. So hope to see you soon.
Take care, everyone. Stay safe.
Bye.